What if the biggest financial disasters in America weren't accidents at all, but part of a repeating pattern that quietly enriches the same institutions every time? Every crash, every panic, every inflation spike seems to drain ordinary Americans, while a handful of banks emerge stronger than before. To understand why, we go back to 1907, when a massive market panic revealed that JP Morgan alone had more economic power than the US government. The crisis became the perfect excuse to build the Federal Reserve, a centralized system shaped by bankers themselves, sold to the public as protection against instability. Instead, it became the foundation of a playbook that would reward financial turmoil for over a century. Once the Fed was created, crises didn't disappear, they evolved. In the 1920s, artificially low interest rates fueled a credit explosion, inflating a bubble that burst the moment the Fed tightened policy. The Great Depression devastated millions. Yet major banks survived by absorbing their weaker competitors and purchasing assets at rock-bottom prices. A pattern emerged: loosen credit to inflate the system, then tighten it to collapse the system, and watch wealth flow upward during the panic. It was the first proof that financial catastrophe, far from being random, could consolidate power. With the end of the gold standard in 1971, money no longer needed physical backing, allowing credit to expand infinitely, and giving banks the ultimate profit engine. The savings and loan disaster, the dot-com crash, the 2008 meltdown each followed the same sequence. Risky financial products exploded, markets overheated, banks cashed out early, and when everything collapsed, taxpayers absorbed the damage. In 2008 alone, Americans lost trillions, while the very institutions responsible were bailed out, merged, and expanded. Crisis after crisis, the same mechanism transferred wealth from the public to the financial elite. By the 2010s, the system had matured into one where crashes functioned like scheduled resets. The Fed pumped trillions into the markets, boosting financial institutions long before relief reached ordinary citizens. Even during the pandemic, the banking sector achieved record profits, while millions of Americans lost jobs and savings. Today, the pattern continues. Household debt at historic highs, inflation generating massive interest income for banks, regional bank failures benefiting larger competitors, and every market downturn followed by a flood of central bank liquidity that lifts corporate balance sheets first and fast. The takeaway is clear: crisis is not a flaw. In the US financial system, it is one of its most profitable features. Banks consistently gain power when the public suffers, because the architecture rewards instability and ensures the largest institutions are protected at all costs. And with this pattern repeating for more than a century, the next crisis isn't a possibility, it's unavoidable. The real question is how much more the system will consolidate when it happens. If you want more investigations into the hidden machinery behind money and power, hit subscribe, turn on notifications, and share this video with someone who still believes financial crises happen by accident.